time out today to join our webinar on corporate tax regime for fee zones in the UAE. I'm Priyanka, I'm Senior Counsel at Oracle, and I, together with our partner Nirav Rajput, will be discussing the intricacies of the corporate tax regime for the fee zone persons, specifically those benefiting from the 0% corporate tax rate. Now, here is a quick overview of what we will be covering today. We will start with a quick introduction to the corporate tax regime in the UAE, outlining specifically rules applicable to free zone companies and branches. Next, we will be discussing the essential terms and concepts of to the free zone regime. This is to ensure that everyone is on the same page. Thereafter, we will be discussing the criteria that a business must meet for a free zone tax benefit to qualify, and what are the important aspects to watch out for. Finally, we will open the floor to your questions. We will try to answer and address as many queries as we can within the time we have today. I again like to thank you all for joining today's session, and let's get started. I'm sure you all know by now that the corporate tax regime is live in the UAE as of 1st June 2023. The law applies to all businesses for financial year starting on and after 1st June 2023. So if your financial year is a calendar year, then your first tax year has already started from 1st January 2024. In terms of rate, the headline rate of corporate tax for taxable persons is 0% and 9%. 0% is applicable to taxable income up to 375,000. Any taxable income in excess of this threshold is subject to 9% CIT rate. Now, we all are aware that free zones are an integral part of the UAE economy. There are more than 40 free zones in the UAE, yet alone in Dubai, there are more than 25 free zones catering to specific sectors and industries. Recognizing the continued importance of free zones, the UAE corporate tax rules have also introduced a 0% preferential corporate tax regime for free zone companies and branches that meet certain conditions. We will be discussing the conditions in detail in slides to come. The free zone person who meets the prescribed conditions will be taxed at 0% on the qualifying income and 9% on the other non-qualifying income. At present, the rate of withholding, so that's the free zone specific rule. In general, at present, the rate of withholding tax is 0% under the corporate tax law, which means that all cross-border payments would be subject to 0% withholding tax, and there would not be any withholding tax implication. Now, this even applies to qualifying free zone persons. There are also general anti-abuse rules and specific anti-abuse rules in the CIT law. Specific caution should be made in respect of these rules, especially if any free zone person is considering any restructuring transactions or business reorganization. These rules must be tested for. Now, in general, these rules give wide power to FTA. FTA can recharacterize a transaction or can also disregard a transaction under this general anti-abuse rules. Apart from that, when it comes to multinational entities, that is entities which have a global turnover of euros 750 million or more. Essentially, in UAE, it was announced that a different rate would apply to such multinational entities. The law at first did not have any reference to the Pillar 2 in production and or implementation. However, later on, references to Pillar 2 implementation were incorporated in the law. The MOF in one of the forum sessions held together with the OECD announced that the Pillar 2 rules will not be implemented in the UAE in 2024 but most likely in 2025 it could be implemented. The public consultation document was also released by the ministry on 15th of March, which was closed by 10th of April 2024. Right now, apart from this, there are no further details available on implementation of Pillar 2 yet. But this is also very important aspect to watch out for, especially for free zones who would be benefiting from 0% preferential rate. Moving ahead to the next session of this webinar is to understand basic concepts and terms which are relevant for the free zone tax regime under the corporate tax law. Now, the key terms which are defined or which are to be looked for under the corporate tax law are the terms which are displaying and reflected on the slide here. Uh, if we go to the first term, which is free zone. Now, the free zone terminology is also defined under the corporate tax law. Uh, it, the definition says that a designated and a defined geographic area within the UAE that is specified in the decision issued by the cabinet at the suggestion of ministry will be treated as free zone for corporate tax purposes. So, specific emphasis on specified in the decision. Um, Till now, there is no separate decision which is being made available or issued by the ministry to list the name of the free zones which will be benefiting from the 0% corporate tax regime. In the recent guide, free zone guide, which was released in the May this year, the FTA has suggested that all taxpayers should check with their respective free zone authority to confirm if they are operating in a free zone for corporate tax purposes or not. So this is one of the important aspects to be kept in perspective. As far as designated zones are concerned, the list of designated zone which is issued for VAT purposes as provided in the Cabinet Decision 59 should be referred to, because that list has been referred in the CIT law as well. Now going ahead to another important definition or terminology, that is free zone person. Now, free zone person term is defined in the law as a juridical, incorporated, established, or otherwise registered in a free zone, and it includes branch of a non-resident person as well. Now, you can see from this definition that free zone person refers to a juridical person as a whole. What does this mean? This means that if any company which has a head office in free zone and have a branch outside free zone, or vice versa, a company which has head office in mainland or any other country and has a branch in free zone, both these companies will be treated as free zone persons, subject to the meeting the criteria, and their mainland or foreign business presence will be considered as domestic permanent establishment or foreign permanent establishment as the case may be. So for example, if a free zone company with a mainland branch, the mainland branch will be treated as a domestic permanent establishment. The free zone head office could then be eligible for 0% corporate tax rate, subject to it meeting the conditions, whereas the mainland branch would be treated as domestic permanent establishment and will be subject to 9% corporate tax rate. Now, when it comes to other types of setup, say unincorporated partnerships, the law, specifically the guidance which is released by the Federal Tax Authority, says that an unincorporated partnership will not be eligible for free zone benefit. This is because it is not a juridical person as a setup. Even this applies even in cases where unincorporated partnerships are opting to be fiscally opaque. So in both the situation, whether they are fiscally transparent or whether they are fiscally opaque, in both the situations they will not be benefiting from the free zone tax regime. Now, Free zone persons are by default are treated as qualifying free zone person unless they fail to meet any of the conditions. So moving ahead to another definition, which is qualifying free zone person. Now, what is qualifying free zone person? The law says that any free zone person, any company, free zone company or free zone branch, which meet certain conditions, they would be first, they would be treated as qualifying free zone person, and only such qualifying free zone persons will be then subject to 0% corporate tax rate on its qualifying income and 9% corporate tax rate on its other non-qualifying income. So for benefiting from free zone person relief, a free zone company or a branch first should be treated as qualifying free zone person, and then they should need to look at whether they are earning qualifying income or not. Now, if a free zone person is treated as a qualifying free zone person, it should be noted that they do not get the benefit of the tax-free threshold of 375,000 dirham, uh, which is there in the law and which is available to other taxable persons. So, to say that if a free zone person qualifies for 0% benefit on its qualifying income, then its non-qualifying income will be straight away taxable at 9%. The non-qualifying income will not further get the tax-free threshold limit. So these were some of the main conditions, main terminologies and concepts which are laid down in the CIT law. Now moving ahead to the qualifying conditions. So after in this section, what we are going to do is we are going to discuss on the main business or main criteria which are laid down in the CIT law, which are essential for any free zone company to meet and to qualify for availing the benefit of 0% corporate tax regime. Now, what we've done over here, you can see from the slide that we have laid down all the 6 main conditions. We start with the most procedural and conditions first, and then we will move ahead to the most more complex conditions, which dwells on what is qualifying income and what is the de minimis threshold. So moving ahead to the first 3 procedural conditions which are needs to be met by any free zone person is condition 1, which is a very basic and I would say is a logical condition in the law, is that the free zone person should not self-elect to be taxable at 9% CIT. Now, now the question here is why a free zone person will be self-electing to be 9% taxable. There are uh, there are many such reliefs and benefits which are not available to a qualifying free zone person, which could be available to a regular taxable person. For example, the tax-free threshold, tax grouping conditions, qualifying the business restructuring relief, so on and so forth. In that cases, the law has given flexibility and an option for a free zone person to self-elect to be taxable at 9%, and this is a flexibility which is offered in the law. Now, once a free zone person self-elects to be 9%, it automatically disqualifies it from the 0% regime. Now, here another important point which has been clarified in the free zone guide as well is that if a free zone person self-elects to be 9% taxable, this will trigger the criteria of a free zone person not getting the benefit, not just for the tax year in which it has opted to be 9% taxable, but also for the next 4 tax years, because this will trigger that a block of 5 years, which in the law it has mentioned that if any of the conditions of qualifying free zone are not met, then the free zone person is disqualified for the tax year in which the conditions are not met and also for the next 4 years. So this needs to be kept in mind that if a free zone person elects to be 9% taxable, then it will disqualify it from 0% regime for the next 4 tax years as well. The second condition is that the free zone person should be must comply with the arm's length principle for uh, which are there under the transfer pricing provisions in the law. This is a mandatory condition for all free zone persons. So, if a free zone person wishes to opt for a 0% CIT regime, it needs to comply with transfer pricing rules when it is transacting with its related parties and also when it is transacting with its permanent establishment, be it in domestic mainland or if it is in foreign countries. So when a free zone company has a head office in free zone and has a branch in mainland which qualifies as a domestic permanent establishment, then even the transactions between the head office and branch needs to be at arm's length. As per the free zone guide, the FTA has clarified that all the transactions between the head office and branch in such situation needs to have proper allocation of income and attribution of income between the head office and branch as per the separate entity approach, which is prescribed under the transfer pricing provisions of the law. Now, apart from this, the free zone person should also meet the transfer pricing documents documentation requirement, which is prescribed under the law, which includes maintaining a local file, master file, and so on. The third condition is the free zone person must prepare and maintain audited financial statement. This is regardless of the revenue of the free zone person. Now, the guide has further clarified that it is not a requirement that a free zone person should maintain separate accounts for qualifying income and separate accounts for non-qualifying income. This only means that the free zone person as a whole should maintain audited financial statements. So there is no requirement to have separate audited financial statement for the mainland branch. It is as a requirement, a free zone person should only have certain details or documentations which the FTA can review to see that the qualifying income has been appropriately calculated. Moving ahead to the fourth condition, which is also one of the critical conditions and which has been clarified more in detail in the guide which was released by the FTA. This condition says that a free zone person needs to maintain adequate substance within the free zone or the designated zone if it's doing the qualifying activity of distribution activities. Now, what is adequate substance is not defined very specifically. It requires that a free zone person needs to perform the core income generating activities within the free zone. It needs to have adequate employees, assets, and operating expenditure within the free zone. So these are the four main points or factors to be considered when the adequate substance condition is being looked at. Now, the test is there is no hard and fast rule for this adequate substance test. The law says and even the guide clarifies that this needs to be looked at from the perspective of like what are the level of activity and taking into consideration the nature of business that is undertaken uh, by the free zone person. There are certain non-core activities which a free zone person may have, like routine activities, which can be back office kind of activities. This can be done. The law allows that this can be done outside of the free zone. Now, the guide also further says that the adequate substance need to be tested for each qualifying activity which the free zone is undertaking, and this needs to be seen separately for each qualifying activity. There are certain illustrations in the guide which gives further clarification on how the adequate substance needs to be maintained in the free zone. It also considers a scenario where if the level of activity is limited, then the free zone person can have employees which are doing multiple core generating activities. So it may not be that there should be employees separate for each core income generating activity. The employees can simultaneously work for different core income generating activities. So that the guide also clarifies this. Um, so if the substance requirement is not met, it disqualifies the free zone again from the 0% benefit. So it's one of the qualifying conditions for 0% regime. Now, moving ahead to the core, uh, what constitutes a qualifying income? At this stage, I'll pass on the mic to my colleague Nirav to take you ahead with the discussions on qualifying income.
Hello, everyone. Very good morning to all of you. Thank you, Priyanka, for walking us through what the free zone person means to begin with, and then deep diving into each of the specific conditions. Now that we understand, that in order to be a qualifying free zone person, there are several conditions to be met. It has been discussed and deliberated, by far, that one of the most critical conditions for a free zone person to qualify is deriving qualifying income. Now, what is qualifying income is something that needs to be looked at in detail. The way the law has been worded, it encompasses, approximately five activities, major five activities, and within each of these five activities, there are some obviously hidden nuances, which we will quickly walk through. So to begin with, when we look at what is a qualifying income, we are only looking at the income of the free zone person. We are not looking at any income which is attributable to its domestic or to its foreign permanent establishment. This being out of our way, let us look at what is qualifying income earned by the free zone person. The first one is the income from transactions with other free zone persons. Now, what does this mean? What does this entail? Is a free zone person earning income from another free zone person is simply going to be qualifying income. There is a hidden nuance that we will quickly cover. This obviously should not relate to any activities which are specifically carved out as excluded activities in the law. The second category of income that a free zone person would derive is income from transactions with non-free zone person. Now, this one is a very, very crazy, income, I would say, in my words, because it has a list of qualifying activities that one must meet. So the free zone person, first and foremost, must earn income from non-free zone persons, and the underlying activities must be qualifying activities. And these activities should not again be excluded activities. That's the second category. The third category is income from the ownership and exploitation of qualifying intellectual property. You'll hear this words qualifying time and again in the free zone regime. We all understand what an intellectual property would entail, but what is qualifying is very important in the given scenario. Only income concerning qualifying intellectual property would fall within the ambit of being a qualifying income. The fourth category is income from the sale or lease of commercial properties, which are located in the free zone and which is also earned from a free zone person. So when the property is a commercial property, it is located in the free zone and it is earned from a free zone person, then again, this income would be a qualifying income. The last but not the least is, it's a cherry on the cake. Any other income that meets the de minimis requirements. What are the de minimis requirements? We'll take a look shortly. Now, let's deep dive into each of these categories of income streams. Now, the first income is income derived from transactions with other free zone person. When we talk about income derived from transactions with other free zone persons, first and foremost, we are carving out everything which is excluded activities. Now, just to hop off and look at what are the excluded activities, these include a host of activities, including banking activities, insurance activities. We have got finance and leasing activities, excluding what is qualifying activities. We also have certain things concerning, ownership and exploitation of immovable property. Now, this is obviously excluding the commercial property located in a free zone where, the income is earned from a free zone person. Then comes any transactions with natural persons. So practically, even if you are a free zone person, and if you only derive income from natural persons, that's simply not going to be qualifying income. It is specifically an excluded activity. There are certain transactions which are accepted here, which are not covered within the excluded activities, predominantly because these activities are in a way covered as qualifying activities. Yeah, we'll look at what qualifying activities are shortly. Just going back, so the first thing, which is income derived from transactions with other free zone person, it does not include excluded activities. And one of the important conditions is that the recipient free zone person who receives the goods and services must be the beneficial recipient. Now, what it means to be a beneficial recipient is defined in the law, and then it is articulated, again explained in slightly more detail in the guidance, in the free zone guide. A beneficial recipient effectively means that the person has the right to use and enjoy the goods and services that he is procuring, he or it is procuring. In this regard, what do you mean by rights to use and enjoy? So here the guidance goes ahead and gives us an explanation that the recipient is not merely acting like a conduit or an intermediary. It is actually the beneficial recipient, and it has the right to actually dispose of or use those goods or services. Now, again, there are several clients who come back to us, and they have weird scenarios or different scenarios, unique scenarios. Typically, there has been given a few examples in the guidance as well. One important thing that the guide also mentions here is that in practice, the seller or the service provider may rely on a written statement or like an undertaking which is shared by the purchaser. And this purchaser clearly mentions that he is himself the purchaser and the beneficial recipient of the goods and services. Again, it is very subjective. We need to go in detail, check, what the underlying documents are, what the underlying transaction is. The guidance also emphasizes that where this supplier, the free zone person, does have an indication that these services or goods may not be directly received by the recipient, which is a free zone person. For example, because the goods are to be delivered to a third person, which is potentially outside the free zone, then in that scenario, such kind of an arrangement cannot be considered as meeting, the beneficial recipient criterion. And therefore, it would not fall within the ambit of income derived from transactions with other free zone person. So with all these nuances in place, let's go forward and dive into the second category of income, which is income derived from transactions with a non-free zone person. Now, this is again a unique one. This has a blend of two major things happening. One is we are looking at transactions first and foremost with non-free zone person. Who are non-free zone person, one may ask? And these are those persons which are obviously not incorporated, established, or registered within the free zones. So it could be persons which are in mainland UAE. It could be persons which are outside the UAE as well. So these two category of persons would be non-free zone person to begin with. The second condition I would say is that the income derived by the free zone person in question is income from qualifying activities. Now, again, there is an exception. It should not be specifically excluded activities that we have already looked at. Now, what is qualifying activities is defined in a very concise way in Ministerial Decision 265 of 2023. Again, these are limited activities. Roughly around 14 activities are qualifying activities. They have each and every activity is specifically defined in the law. Only income which falls within these activities, which are qualifying in nature, earned by the free zone person, would fall in this second category of qualifying income. Now, quickly, we're not going to deep dive in each and every category of qualifying income, but just for your reference, these are the 14, qualifying activities on screen that you see. Now, here again, certain activities you would notice relates to goods, certain activities relates to services, certain activities specifically caters to related party transactions. Now, just quickly to touch upon these, we have got manufacturing of goods or materials, we have got processing of goods or materials, we've also got trading of qualifying commodities, which is very niche and slightly tricky as well as in our experience. We have also got distribution of goods or materials, which is in or from a designated zone, a very important activity and potentially something to deep dive into in today's session as well. We've also got logistics services, fund management services. We've got ownership management and operation of ships, and certain other activities. We are not going to touch upon all, but we are going to touch upon three key activities. We would say one is the distribution of goods or materials. We're going to deep dive into headquarters services, and we are also going to look at holding of shares and other securities. Other activities are also important, but given the time frame of an hour, we will only focus on these three qualifying activities. Let's start with the distribution of goods or materials in or from a designated zone. Now, this one is a very powerful activity. It impacts a lot of companies which are operating in the free zone to begin with. But again, the words which are used in the law here is not free zone, is a designated zone. Now, there is a slight difference between free zones and designated zones. When we talk about free zones, they practically, like Priyanka already mentioned, they encompass all the free zones in the country, whether they are fenced, whether they are not fenced, as long as they are free zones practically, from a VAT point of view. And they also are free zones which are listed in a cabinet decision, which is not yet out. Practically, they should fall within the ambit of free zone. When we talk about designated zones, again, designated zones are practically under the umbrella of the larger free zones. These are specific geographic areas. They are fenced, let's say, zones, and they are listed in the VAT law as being designated zone. Plus, they are also listed in the cabinet decision, which is not yet out. When all these things will meet, will come together, we will know that, okay, this is a designated zone. For example, today we know that, for example, Javza, certain zones are fenced within Javza, and those are dedicatedly designated zones, compared to DIFC, which is not a fenced zone, and it is still a free zone, but not a designated zone. Now, why to get into this kind of a discussion is precisely to understand to which activities will the distribution of goods or materials apply to. Now, here, what we understand is that distribution of goods or materials, it includes, to begin with, buying and selling of goods. It could be materials, it could be raw materials, it could be components or other tangible or movable items. And it may also include importation, storage, inventory management, handling, transportation, and exportation. Again, it is very important that these goods are for reselling or resale, and practically not for consumption. So we are looking at only B2B effective transactions and not ideally B2C transactions. And last, but the very important condition is that these activities must be conducted in or from a designated zone. And when these goods enter the UAE, they definitely should be imported through a designated zone. Now, what does this mean? Let's break it up into a few parts, right? So first and foremost, we understand that there may be importation of goods. It is not a mandate that the goods should be imported. So a majority of businesses that today operate from a designated zone, like Javza, for example, who are just going to buy goods, moving from, let's say, China to India, and those goods practically do not ever enter the territory of UAE. Would they fall within the ambit of distribution of goods and materials? Yes, they would fall there, provided, obviously it is for resale and it is a B2B transaction. The goods are not mandatorily required to enter into the UAE. The important condition here is that the activity per se is conducted in or from a designated zone, which means that the office of such a free zone person must be in a designated zone, and the substance requirements must be met again in the designated zone, as highlighted previously by Priyanka. Now, again, now that the high seas sales is or drop shipments, as one may call, is out of our way, let's talk about goods practically, which enter the UAE. Whenever the goods enter the UAE, they must mandatorily enter through a designated zone. If they are not going to enter through the designated zone, it will not fall within this activity of qualifying income stream, let's say. Again, there is no limitation on the mode of the distribution. So it's very open-ended. As long as you fit within the larger definition, you would fall within this qualifying activity. We have also discussed that goods cannot be for the end user, so we are looking at only B2B transaction, just to repeat. And lastly, the distributor holds the title to the products. This differentiates distribution from logistics services. Now, what does this entail, or what does this mean? So effectively, we know that whenever there is going to be importation of goods in the UAE, generally there will be a logistics service provider who may be hired by businesses. And at large, whenever there is such kind of a logistics service provider, it is important to distinguish them from the distributor, because distributor, they hold the title to the goods, but logistics service provider, they generally do not hold the title to the goods. They simply take care of the movement of the goods and not really, own the goods. They are not the owner of the goods. So this is also one thing which is important to note here. So whenever the transaction is with a distributor, one may need to come back and look at either distribution of goods or materials when it is with a non-free zone person, or if it is with a free zone person, one will go back to the first category of qualifying income between two free zone persons. Okay. Going forward, let's look at the second important activity, qualifying activity, which is holding of shares and other securities, specifically for investment purposes. Now, this is also a very interesting one. Here, the lawmakers, they go into detail first and foremost to explain what is shares and other securities for investment purposes. Precisely, this includes shares of any classes in the share capital of any other juridical person, which is like a legal person, or any other type of equitable interest, which will entitle the holder to receive profits and liquidation proceeds effectively. They do not talk about any cap. So we do not need to worry whether you hold 1% or you hold 10% or 100%. As long as you hold shares and securities, which could include ordinary shares, preferred shares, it could include redeemable shares, or it could also include beneficial ownership in the company, then it would be akin to holding of shares and other securities. The second types of instruments could be negotiable or non-negotiable financial instruments. Now, again, this encompasses a lot of financial instruments like derivative instruments. It could include, financial assets. It could include cryptocurrencies like digital assets and other investment instruments. Again, the important thing is there is practically a right to purchase a security, and you have the right to get the returns from holding of such securities. Now, once a free zone person is going to hold these securities, any income in the form of dividends, or it could again be capital gains from the sale of such securities, that will precisely fall within the ambit of holding of shares for investment purposes, and it would be a qualifying income subject to the zero rating provisions. Important, again, one more important thing here is that such securities should be held or intended to be held for an uninterrupted period of at least 12 months. So we need to ensure that the shares and securities are held by the free zone person for at least a duration of 12 months, which is a year. Lastly, needless to mention, this is actually somehow assumed, but the guide does emphasize that activity which involves trading of shares is not a qualifying activity. We are looking at something which is more of an investment and not a speculation or a trading activity. Yeah. Taking forward, which is the third qualifying activity, which is again something which one needs to look at in detail, is the headquarter services to related parties. Again, this particular activity has been explained in quite meticulous detail in the free zone guide, and we encourage you all to go back and look at this particular activity specifically in the guidance, because it is very detailed. Now, when we look at the guidance and the ministerial decision as well, it is defined in a very broad way to begin with. So just to read it out again, headquarter services to related party, it practically includes administering, overseeing, and managing, of the business activities of related parties. It includes the provision of senior and general management services. There is captive insurance services, which is practically for the group companies itself. There is also administrative services, procurement services. There could be business planning and development. There could be risk management being undertaken, coordination of group activities, and in general incurring expenses or expenditures on behalf of related parties and providing other support services to related parties. The reason why I'm reading this, in a very laborious way, is because each and every item which is listed in the definition itself is practically further, explained by the free zone guide, and it is very important to identify which activity the free zone person undertakes and whether that activity per se would fall in any one of these categories. Again, just to go back, we're not going to touch upon and go into significant detail, but it is very important to know that whenever we are looking at this category, there is, in hindsight, services being rendered by a free zone person to its related parties, and the group as a whole is practically being benefited by way of receiving these activities from the free zone person. Again, it could be group which is resident in the country. It could be group entities which are non-resident related parties as well. Very important to go and identify the activities, because certain activities within all these activities could be for the benefit of the whole group, whereas certain activities could still continue for one of the related parties and not necessarily for the whole group. But it does, in hindsight, give the benefit for the whole group, right? So one will need to go into detail, look at specific contracts, look at specific intercompany agreements, and look at the underlying transaction flow, look at the substance over form, and then determine whether the activities in question, do they fall within the ambit of headquarters services to related parties or not. Now, taking it forward, while we have touched upon all these conditions, I'm just going to swing back to the qualifying activities and just talk about one additional point on treasury and financing services to related parties. Now, what we also learn is there are at times where companies do fall in one of these qualifying activities, but in the background, they also might earn something which is, for example, interest lying in a bank account in the country. Now, what happens to that interest? And let's assume that this interest is substantial. Yeah, we are talking about circumventing the de minimis rule in this case, which we'll also look at shortly. So, in this particular situation, the guidance goes into detail, and it further emphasizes that any interest earned by a free zone person, which is practically coming in the form of savings account interest, let's say, that is a treasury and financing services to oneself, to a related party, and therefore it falls within the ambit of treasury and financing services to related party. Doesn't fit the bill when we just look at the headline, but the guidance explicitly covers it. So this is also one interesting point that I thought I'll share with the participants here. Okay, now I'll go back to the third activity, practically meeting, or let's look at the last activity, which is meeting the de minimis rule. Now, this is also an interesting one when we talk about meeting the de minimis requirement. So let's understand what the de minimis requirements are. We spoke about, okay, I'm just taking a step back, just a quick overview of where we are. It's easy to get lost in the whole free zone regime, right? So we are looking at, firstly, a free zone person. This free zone person will become a qualifying person if it meets, practically all these 6 conditions. We have circumvented, and let's say we jump through all the hoops until condition number 5, right? Now we come on the condition number 6, which is meeting the de minimis rule. De minimis rule goes into detail and says that a free zone person could still earn something which is non-qualifying revenue. And this non-qualifying revenue, if it is below the thresholds mentioned here on screen, then this non-qualifying activity is still going to be considered as a qualifying income, and it will still be subject to 0% corporate tax rate. The threshold being 85 million in the financial year, or it is 5% of its total revenue. Again, when we talk about these 2 thresholds, we are looking at the lower of these 2 thresholds. So it could either be less than 5 million, or it could be lower of 5% of its total revenue. Once you meet these thresholds, practically that non-qualifying income would still be considered as qualifying, subject to a 0 rate. Important here is to identify what is non-qualifying revenue and what is total revenue. 2 things, right? something which is falling in the list here that you see on screen, which is excluded activities, which could be activities that are not qualifying where the other person, so this is a transaction between two free zone persons and the recipient free zone person is not the beneficial recipient, then this is also a non-qualifying revenue. And the last is the transactions with a free zone person. The last one is the transaction where the other party is a non-resident, person or a non-free zone person, and it is not the falling within the ambit of the qualifying activities, right? So three categories: excluded activities, transaction between two free zone persons where the recipient is not the beneficial recipient, and the third thing is earning income from a non-qualifying activity. So in these three scenarios, such kind of revenue will become non-qualifying revenue, and this revenue should be less than the thresholds. Taking it forward, what is something which is total revenue? When we talk about total revenue, why do you need to know about the total revenue? Is because of this condition, which is the second threshold, which is 5% of its total revenue. So in order to understand on what element of income we need to calculate this 5%, we need to understand what is total revenue. And here the lawmakers have given you what it means to be total revenue. Practically, the total revenue will be qualifying revenue plus your non-qualifying revenue that we saw here. And it will exclude something which is naturally a taxable income. What could be a taxable income? Income attributable to a domestic or a foreign PE, completely outside the free zone. The second category is income from immobile property. Here we are talking about immobile property, which is obviously excluding the commercial property located in the free zone and which is also earned from a free zone person, which is obviously a qualifying income still. Anything besides that is non-qualifying and it is a taxable income. Sorry, it's not non-qualifying, it's just a taxable income. And the last category, which is income from the ownership or exploitation of intellectual property. Now, when we talk about intellectual property, the lawmakers have gone into detail to explain and create a stark difference between what is intellectual property and what is a qualifying intellectual property. Just to circle back and let you know that qualifying intellectual property effectively would include intellectual property such as patents. It could also encompass something which is specifically in similar nature of patents, which needs the requirements of being registered, and there is some regulations around such legalization in practice. So those kind of intellectual properties are going to be qualifying intellectual properties. And practically any expenditure which specifically relates to such qualifying intellectual property, like R&D in specific, those will have a nexus, and effectively income relating to such qualifying intellectual property would be qualifying income. Everything which is excluding such qualifying income is still income from intellectual property, but not qualifying in nature. It could include trademarks, for example, or marketing intangibles. Companies or businesses would not naturally earn qualifying intellectual property income from such kind of IPs, let's say. So precisely these three kinds of incomes are taxable incomes, and they are not non-qualifying revenue from a free zone regime point of view. So once we identify what is qualifying, what is non-qualifying, we take the total of the two and we apply the 5% on such kind of total revenue. We compare that 5%. Let's assume that 5% is 4 million and we have 5 million, which is another threshold. The lower of the two elements is our upper limit, and the non-qualifying revenue should not exceed the 4 million mark in the example that I'm just giving. Yeah, I hope this is clear. Okay. Lastly, we spoke about taxable income of a free zone, of a qualifying free zone person. Just to repeat again, we already discussed this very briefly. Again, income attributable to a domestic or a foreign permanent establishment, it is going to be subject to 9%. Income from immobile property, again, which is not commercial property, simply put, is going to be taxable income. Income from commercial property but not located in a free zone, still a taxable income. Income which is a commercial property located in a free zone but not earned from a free zone person is still a taxable income. Last but not the least, we're touching back again, income from the ownership or exploitation of intellectual property, which is not obviously a qualifying intellectual property, is still going to be a taxable income. So these incomes would be subject to 9% corporate income tax rate, already highlighted by Priyanka earlier, that the threshold of the 375,000 dirhams will not apply to such incomes which are taxable income. And, practically these incomes would directly be subject to the 9% corporate income tax rate. We are coming to almost the last section of our webinar, and which is points to watch out for. Now these are some points that we thought we'll discuss with the group, and once we are done with this, we'll open the floor for everyone to ask questions. Obviously we won't be able to address and answer all the questions in the short time frame that we have, but we'll try our best to cover as many questions as possible. Yeah. So what are the points to watch out for? Like we mentioned, and this is somehow in hindsight already covered in our webinar, but we thought just to emphasize these. So the first point is businesses should consider undertaking a thorough QFZP analysis before concluding that it is a QFZP. Why? Why? Because the default rule is that a free zone person is a QFZP. So practically they will be subject to the free zone regime unless they will go forward and elect to be subject to 9%. Now, as already, we went into the details of these 6 conditions, right? And you could already see that within each conditions, there are several conditions and there are several hurdles that one needs to practically hop on and then confirm that, okay, we meet practically all the 6 conditions in the way the lawmakers have, further elaborated in the guidance, and then conclude that yes, they do fall within the ambit of a qualifying free zone person. Hence, we would encourage you all to undertake a detailed study as to identify whether the free zone person in question falls within the ambit of the qualifying free zone person regime or not. The second most important thing we would say is within the analysis of the QFZP, you should go into detail and look at each and every qualifying income and each and every qualifying activity again to connect the dots with how the FTA, the Federal Tax Authority, is interpreting the activities, and then determine whether, the facts of the case in the question, whether the documents that you have which support the underlying transaction flow, it effectively meets, it marries the understanding of the FTA, and then you conclude that yes, there is a qualifying income, there is indeed a qualifying activity, and all the conditions are effectively being met. Yeah, so that's also one important thing to watch out for. The third thing is, the day the law came out, it took another practically 7-8 months for the qualifying free zone regime to come out, which was end of May 2023. After that, we saw a revision in the entire free zone regime sometime in August 2023. And thereafter, we saw the guidance was published earlier this year. So you can understand that the lawmakers have been deliberating on this topic since a while, and they have gone into enormous detail to filter out on what is not qualifying activities or what falls within the ambit of qualifying activities, right? Companies are pushed and pulled in different directions in order to manage, their own tax exposure. And in order to take the benefit of the QFZP regime, a lot of companies, a lot of businesses are trying to somehow restructure a few transactions or restructure the whole group as a whole. They are looking at, the business in the country in a different light with the corporate tax coming into play. This being said, QFZP is one target area to get into the benefit of the QFZP regime. While the companies and businesses may go ahead and do this, obviously they need to ensure 2 things are taken care of, which is the general anti-abuse rule, which is by far one of the most dangerous rules. I would say the devil in the law, and it could hit you. And we don't know from which direction. Yeah. So general anti-abuse rule, which practically takes care of any restructuring, any reorganization that businesses might do from the day the law was, practically published, which was 15th of October, which is effective date, which was 15th of October 2022, and till now, let's say. So if you do any restructuring, the GAR provisions must be addressed. One needs to look at whether you do everything everything, every restructuring or every transaction restructuring practically is supported by a commercial reason. And you're not simply doing the restructuring or reorganizations to take the benefit of the corporate income tax. It should not be done merely to get the benefit of corporate income tax. The second most important thing is the transfer pricing provisions. Now, transfer pricing in itself, we would say, it would practically take another 2 hour session, let's say, just to talk about the transfer pricing rules. They are very elaborate, but they are also aligned with the OECD principles, the OECD policies, right? So one should not undermine the application of the transfer pricing provisions. There is a lot of companies or a lot of businesses which route transactions between related parties, obviously for several commercial reasons, but amongst those commercial reasons, there could be a hidden risk, and that is something where the transfer pricing rules should be looked at meticulously, and one should ensure that they are in line with the TP provisions. Now, while the TP provisions and the general anti-abuse rules, these are applicable to everybody, all the taxable persons in the UAE, typically from a QFZP point of view, it is more important. Why? Because the moment you fail to meet the TP provisions, simply put, you fail to meet one of the most primary conditions of being a qualifying free zone person. So you might have the qualifying activity, you might have qualifying income, you meet the substance requirements, but if you fail to meet the TP provisions, the lawmakers could simply say that, okay, you don't meet one of the conditions to be a qualifying free zone person, and therefore you are not a QFZP, and not just for year number one, like Priyanka highlighted, it is going to impact you for the next 4 years. So in total, you lose the QFZP benefit for 5 consecutive years, regardless of you meeting those conditions. So again, failure to meet the TP provisions comes with significant impact, and we encourage you again to take a look at transfer pricing provisions in detail to ensure that you meet all the conditions. Last but not the least, I think we highlighted this previously. Priyanka did mention it, that certain reliefs are not available to qualifying free zone persons, such as tax grouping provisions. You cannot take the benefit of it. Restructuring reliefs, you cannot take the benefit. You cannot take the benefit of qualifying group relief again. So these are something that the companies or the free zone persons must they will somehow not be able to benefit from these schemes. But at the same time, one needs to go forward and look at the qualifying activities. Perhaps you fall within the ambit of one of those qualifying activities, and therefore you don't even need the benefit of these reliefs. So with this being said, we'll quickly open the floor for some Q&A. Obviously, we can understand that you have come here, and there are several questions that you would want to ask us. So we will have 15 odd minutes to chit chat with you all and try and answer a few questions. Yeah. So we'll open the floor now for the Q&A. Okay, so I think what we can do is we'll just request our host to open the floor for the Q&A, and feel free to post your questions in the chat box. I don't see them. Okay, so let's start with the latest questions. There are around 30 odd questions. So Reena is asking us, is there any chances to waive the penalty imposed for the late registration of free zone company? An interesting one. What we saw is already, the penalty regime is more so engraved in the portal itself. It's more automatic, I would say, rather than the FTA sitting and punching records. So you can go ahead and apply for a waiver, I would say, but in principle, the penalties would still appear. You can go and follow the process for getting the penalty waiver. Yeah. The next one is regarding GAR. Typically, what are sound commercial justifications for restructuring within a group, which results also in tax benefits? Now, again, this is this is a very tricky one, and we do not have a flat answer for this. But what we can definitely say is, when we talk about commercial justifications in one of the early guidances published, which is the explanatory guide published by the FTA, they did infer that commercial reasons could be to align policies with the group. For example, commercial reasons could be to ensure that practically you are trying to meet certain objectives which came up now, or which were being contemplated by the companies. So this would be one of the few commercial reasons, but again, each case is very specific, and it's very, very subjective to look into this. Yeah. So I'll go with the question raised by Marcus. So he's asking: is the conclusion of the presentation that it is probably of sound practice to have rather more than less legal entities in the free zone as to meeting all the conditions? This is one way, Marcus, that you can look at it, whether to have more than one entities or not. One may still need to have more than one legal entity or more than one, let's say, taxable person in the free zone, depending on the business. You might need more than one entities in certain scenarios, but where possible, it might simply be okay not to have more than one legal entity in the free zones. It is highly subjective. Again, the answer would lie in the nature of the business which is undertaken by the group or the companies. It would also lie in terms of whether one of those legal entities, if they don't meet the conditions, they go forward and they elect to be subject to 9%, making it redundant that you are present in the free zone or not. So it is highly subjective again. We have another question from Tatiana. If a company is engaged in the distribution activity, but in the course of this activity, the company assigns the debt before the supplier to another company, or the buyer of the resold goods is changed, the original one assigned its payment and obligations to another company, is it still a qualifying income? Okay, so I'm just going to break this down just so that I can also understand it. Yeah. So she's asking, if a company is engaged in the distribution activity, but in the course of this activity, the company assigns the debt before the supplier to another company, or the buyer of the resold goods is changed, the original one assigned its payment obligations to another company. If I understood that correctly, maybe Priyanka can chip in as well. But if I understood this currently, we are looking at a free zone person which is in a designated zone undertaking distribution activity, and the company is practically selling these goods to another company, which is, I believe, a non-free zone company. And in the course of this, the payment is made by the customer directly to the supplier of the free zone person. So whether this would have any implications, to me, the beneficial recipient criteria is only applicable to when the transaction is between two free zone persons. So we are not looking at the beneficial recipient criteria when we are already undertaking a qualifying activity to begin with. So in this case, as long as we fit within the ambit of distribution activity and the payments are made directly by the customer to the supplier, it should be okay in my view. Yeah. Okay. So there is one more question from Naina. Okay. So if seeking qualification under treasury and financing activities, would foreign withholding tax absorbed by free zone person in course of earning interest income earned from subsidiary outside UAE qualify under ancillary activity to get status of QFZP? Priya, you want to take this? So it is the one raised by Nina. This is one. we've got if seeking qualification under treasury and financing activities, would foreign withholding tax absorbed by the free zone person in course of earning interest income earned from subsidiary outside UAE qualify under ancillary activity to get status of QFZP?
So basically, and it was also a question of another participant, the foreign withholding tax, if any paid by the QFZP, will be a cost to QFZP. It's not allowed as a foreign tax credit. Now, if I've understood your transaction correctly, you are mentioning that if there is any foreign withholding tax which a QFZP treats as cost, and then in that course, if it is earning any interest income from its foreign subsidiary, uh, whether it will be still be treated as ancillary activity um, to get the qualifying activity benefit or not. Now here you have to break the transaction. One transaction is with respect to the expense that will happen by incurring foreign withholding tax, that will surely become a cost to the qualifying free zone person. Now the second transaction is when the free zone person will earn interest income from their subsidiary. Now that earning interest will definitely be a treasury and financing qualifying activity, but the subsidiary should also qualify as a related party as per the related party definition in the law, which is 50% or more of shareholding. So if that happens, it will be still getting the benefit of the qualifying income and qualifying free zone person. If we go to another question, which has been asked, is if we are applying for a foreign PE exemption for an Iraq branch of a UAE head office company in a Dubai free zone, is if there is a portion of Iraq job done in UAE, will this revenue be reported still by Iraq branch or in the UAE headquarters? Now, what does the free zone guide says that if there is a foreign branch and a UAE headquarter, then both of them should be treated as separate entities for identifying the income that will be attributable to the foreign branch and the UAE headquarters. So it is irrespective of where the job is done or where the services has been undertaken. What is more important is who is undertaking the functions, risk, and assets. So basically, what in transfer pricing it's called as a FAR. Analysis. So who is responsible for undertaking that activity? Who is the risk bearer of that activity? And accordingly, that office, be it a foreign branch in your scenario, will be the one where the revenue will be allocated in respect of that transaction. And that revenue, if it is attributable to the foreign PE, then it will be for UAE, it will be treated as 9%, but you also get another benefits under the UAE law, which is the foreign income exemption benefit or the foreign tax credit benefit. So it will depend on which country and what taxes are applicable over there, and you can still get under the benefits under the law.
Yeah.
Moving ahead to other question, which is again with respect to what if a company during its tax period re-domiciles from the free zone to a designated zone, will there be a split in the tax year? Now, this question needs to be looked at from all the facts of the activities and what kind of activities the company is doing. So if we are saying that the company is in a free zone at the start during its tax year, which is not a designated zone, and undertaking distribution activities which requires to be done through a designated zone, and during a current tax year, if the company relocates to designated zone, then in the tax year itself, the conditions of substance and also the condition of distribution activity should be done from a designated zone will not be met, because the tax year has already started. Now that will automatically disqualify the company from getting the benefit in that tax year and consecutive next 4 years. So even if it is re-domiciled to designated zone, it is most likely not going to be benefiting from QFZP benefit for a block of 5 years. Now, after 5 years, you can relook at the conditions and see whether it can be satisfied or met.
So also one more question, just quickly picking up on it. The free zone recipient should be a beneficial recipient. Does this statement not apply for the distribution of goods between two free zone persons to qualify as a qualifying free zone person? It definitely applies. To answer your question, again, it is very important to note that when we look at qualifying activities versus when we talk about transaction or transactions between two free zone persons, the qualifying activity is where you expressly do not need to meet the condition of being a beneficial recipient. The beneficial recipient condition comes into play only when the transaction flows are between two free zone persons. Yeah, hopefully this answers.
Done. 12:50.
Okay, we'll just take two more questions and then close the show. So we are saying by Shailender, if the de minimis criteria is breached, does the entire status QFZP gets lost and the entire income is taxable? Your understanding is correct. If the de minimis threshold is not met, practically, the entire income, all the other qualifying income would be subject to 9% corporate income tax. So you would lose the qualifying free zone person status. Yeah.
Yeah, we will take one question from Dan because he's specifically saying that his questions are not selected. So I'll take one question which early in the webinar you asked. Is the undertaking letter from the buyer of goods in the mainland stating that they will only resell its purchased goods from designated zone company necessary to support that the latter has non-qualifying income? Now, so firstly, we have to see that whether this activity has been done through a designated zone or not. And secondly, it is requirement if the goods have been sold to another non-free zone person, then there is a requirement that the customer should be a reseller. So though it is not mentioned in the law, it is a good practice to take an undertaking from the customer, saying that they would be resellers of goods and not the consumers. There is no requirement to have an undertaking stating that the goods have been purchased or the activity is done from the designated zone. It is something that you will have to establish through documents, that where the sale is happening or where the title in goods is passing, mostly through your sale contracts. I hope that's the last question we could answer today. We are sorry we have limited time and therefore we cannot take all the questions that you have. But yeah, what we'll be doing is we will be sharing our slides and this presentation as well after this webinar.
Perfect. Thank you, everyone, for your time today. It was a pleasure, coming here and speaking before all of you. We hope that this webinar helped you in some way. We will potentially, come out with another session, dedicated on these topics sooner than later. So hopefully you enjoy and have a nice day ahead. Thank you very much again.
Thank you again.